Recently, the U.S. stock market's AI sector has been hit by a severe sell-off, rivaling or even surpassing last year's DeepSeek storm. Once high-flying AI beneficiaries, AI-related power stocks, and related sectors came under broad pressure, with significant selling in leaders like NVIDIA, AMD, and Micron. AMD plummeted 17.3% on February 5, 2026, marking its worst single-day drop since May 2017 and serving as a stark symbol of the sell-off. This dumping AI frenzy has not only led to a historic rout for the momentum trading strategy that dominated markets for over 2 years, but has also left many investors confused. Beneath seemingly calm major indices, what is the root cause of the volatility? Is this an AI sector correction or a trend reversal? How should everyday investors manage their holdings and respond rationally? Unlike past sector declines, which often had clear catalysts, this AI sell-off stems from a combination of market self-adjustment, trading strategy reversal, and underlying sector fragility, with no single direct piece of bad news. The core issue is the convergence of multiple factors. The most critical is the reversal of the momentum factor, leading to an unwind of extremely crowded trades. Since mid-2022, momentum strategies have long dominated the market, with the AI sector as a hot favorite becoming a core holding for momentum traders, resulting in extremely crowded positioning. Recently, this strategy suffered its worst setback in over 3 years, with momentum portfolios from Goldman Sachs and Morgan Stanley performing poorly. Investors began actively reducing exposure to previous winners, causing the AI sector to drop 8.5% in a single day, with subsectors like memory chips also correcting over 6%. Simultaneously, fragile market structure amplified the volatility. Morgan Stanley estimates that leveraged ETFs faced roughly $18 billion in selling pressure on the worst day, concentrated in tech and semiconductor sectors. Coupled with a decline in market makers' gamma exposure, the market entered a net short gamma state, creating a vicious cycle of selling begets lower prices, which begets more selling. Furthermore, a severe disconnect emerged between major indices and individual stocks. The average movement of S&P 500 components was about 7 times that of the index itself, with market pain highly concentrated in the AI arena. The absence of retail investor participation meant the sector lacked a crucial source of buying support, intensifying the corrective pressure. Notably, an index blending momentum with low volatility gained 3.94% from December 31, 2025 to February 5, 2026, highlighting a market shift toward low volatility, defensive assets, a stark contrast to the high volatility in the AI sector. In response to the sharp sector adjustment, Wall Street giants Goldman Sachs and Morgan Stanley offered interpretations with both consensus and divergence, each updating views based on recent stock-specific developments. Goldman Sachs views the pullback not as a change in the fundamental narrative, but as a normal correction as the market rationalizes from excessively chasing earnings expectations. Historical precedent suggests such momentum stock corrections often present mid-term buying opportunities. However, Goldman also notes the absence of panic-selling signals and warns of further near-term downside risk. Morgan Stanley takes a more cautious stance. The firm not only maintains its sell the rally view, but also lowered AMD's price target from $260 to $255 due to disappointing earnings expectations. UBS also cut its AMD target to $310, citing core concerns. AMD's Q1 revenue guidance failed to meet the high investor expectation of $10 billion plus, and the company took a $440 million inventory charge related to U.S. export controls, with significant revenue decline expected from older chips in China. Both banks agree the sell-off does not represent a long-term trend reversal, attributing it primarily to short-term positioning adjustments and amplified volatility. However, they concur that near-term downward pressure is not yet exhausted. For the medium term, investors should focus on changes in sector fundamentals and fund flows. The broader sector performance supports this. An iShares ETF tracking the AI sector is down 10.28% over the past 3 months and has continued weakening since February, underscoring the near-term corrective pressure. For investors navigating the AI sector's wild swings, the worst moves are blind panic selling or impulsive bargain hunting. A steady approach is needed, grounded in personal risk tolerance and guided by the principles of avoiding crowded trades, controlling position size, discerning stock quality, and waiting for clear signals. First, avoid crowded names. Steer clear of recent high-pressure stocks like NVIDIA and AMD, as well as overhyped AI concept stocks. Don't be lured into chasing short-term rebounds to avoid buying at peaks. Second, strictly control position sizing. Limit AI-related holdings to 20% to 30% of the total portfolio, balanced with low-volatility assets like defensive stocks and bonds for risk hedging. Third, differentiate investment quality. Discard the buy-anything AI mentality. Focus on companies with core technological moats, stable cash flows, and clear profit expectations, or consider AI-enabled, undervalued traditional industry players. Avoid pure concept plays. Finally, resist the urge to blindly catch a falling knife. Wait for clear entry signals. Watch for significantly increased sector trading volume, stabilization in leading stocks, the momentum factor finding a bottom, and shifts in institutional expectations. Then, gradually build positions in quality names to mitigate short-term volatility risk. This AI sector sell-off represents a rational return after market euphoria and a test of investors' risk awareness. Near-term volatility, driven by the unwind of crowded trades, fragile market structure, and individual stock earnings pressure, is likely to persist. However, from a medium to long-term perspective, AI's status as a core engine of global tech advancement and its growth thesis remain intact. This correction, in fact, offers disciplined investors an opportunity to sift for quality and build positions at lower costs. For investors, maintaining rationality, adhering to a steady strategy, respecting the market, controlling risk, and avoiding reactionary moves to short-term noise are essential to navigating the risks and seizing the genuine opportunities in the long-term AI landscape.